in this video, I'm going to point out 5 key areas that fund managers might be looking in 2023, and they are these 5 key areas. Number 1 is banking, number 2 is REITs, number 3, tourism, 4, commodity, and 5, automotive sectors. So we're going to go through each of them in details. Please don't go away. The first one, banking. We all know that the US is going to increase interest rate. What will happen is that if you are holding a lot of cash from all this quantitative easing in the past, what would you do is to save money in the US because it starts to give you yield. What is happening is that it is going to pull a lot of money to the US from other parts of the world, and that is going to affect other currencies in other parts of the world. So what will happen is that other countries are going to increase their interest rate as well in order to neutralize that impact. Now, this is the first time in many decades that all the countries around the world are increasing interest rate at the same time. So in the past, people say cash is trash, but today, cash is actually a very valuable asset. And looking at the condition in Malaysia, Malaysia Bank Negara has also reacted to the Fed interest rate hike in the past. Now, if you look over here in 2022, the US has increased the interest rate by 6 times, but on the other hand, on the Malaysian situation, we have just increased the interest rate by 4 times, and each time it's a lower quantum compared to the US. 75 basis point against Malaysia, each time about 25 basis point. But don't need to worry about what all this quantum means and how much does it affect the forex rate and all that, because what I want to point out is this. Now, when banks increase the interest rate, what happens is that the FD in your bank account is not going to increase the interest rate immediately. Why? Say for example, you have 10,000 ringgit saving in the bank, and let's say this FD, it's a 6 months tenure by giving you, let's say for example, 4%. When Bank Negara increase the interest rate by 25 basis points today, what is going to happen is that because you have a contract with the bank for the next 6 months, the interest rate of that contract is not going to change until that 6 months has expired. Which means to say your FD is going to adjust the interest rate only after this 6 months has expired. And during this period of time, whatever increase in interest rate is going to benefit the bank. But let's say you have a loan with the bank of, let's say, 1 million ringgit to buy your dream house, and Bank Negara decided to increase the interest rate by 25 basis points. What is going to happen is that the bank is going to adjust your loan by 25 basis points immediately, and that creates a better profit for the bank. But on the other hand, your FD rate is still sitting there on a 6 months contract. So the bank don't need to pay you that much, but it has already collected more money from your loan. And that's why on the increasing interest rate environment, it is very good for the banks because they are able to make more profit. Here are some of the examples of the banks in Malaysia, and as you can see over here, in terms of dividend yield, they are able to produce a range of between 3.2% all the way up to 8.6%. So depending on your risk appetite, basically banking stocks is going to provide you with a very solid dividend yield. And if that suits your investment style, just pick one of the banking stocks that gives you the best result. Next, let's talk about REITs. But before we go into REITs, I want to draw your attention a little bit on property investment. Now, why people always say that property investment is good is because of this thing called leverage. Now, if you buy your first home, second home, or third loan, very often you hear that you're able to get bank loans up to 90%. In fact, if this is the first time you're buying a house, what it means is that all you need to do is to fork out 10% down payment of the house, and the remaining 90% is being taken care of by the bank. So it is very easy for anyone to actually buy a house because the initial investment is actually quite affordable. Now, it's even more lucrative if you rent this property out to get some income. So let's say, for example, if you're servicing your loan of 2,000 ringgit per month, but you're able to rent it out for 3,000, right? So on a net basis, you're actually making a profit of 1,000 every month, even though that every month you need to fork out 2,000 to pay the bank. So that's why property investment is very lucrative. But property investment comes with its drawbacks. One of the drawbacks is that you need to manage the house yourself. If there's leakage, then you need to call the plumber and things like that. Apart from that, every month you need to pay maintenance if it is a strata title house. So that comes with a bit of cost as well. And not to forget, all this means the time time that you need to fork out to maintain the house in a good condition. This is where REITs become interesting because you don't need to do any of that. In a REIT structure, what happens is that there will be a company set up where they hire all these professionals to manage all this property, and all you need to do is just pay all these professionals a fee. They manage your property, they collect the rent, and then they will give you back all this rent in terms of dividend. So if you don't like all this hassle, then REITs is the thing that you want to pay attention to. Before we go further into REITs, I want to share this little trick whereby institutional investors actually look at REITs and they compare it against bond. Why? Because they actually share very similar characteristics. Number one, both REIT and bonds, they give you a very steady stream of income because every month people pay rent, and for the case of bond, every month they will pay coupon payment to their bondholders. Secondly, both asset classes are deemed as pretty safe because it is not like a tenant will run away the next day. They are in fact actually locked down by a contract of 1 to 2 years. And for the case of bond, usually the tenure of a bond can last all the way up to 30 years. So that makes this kind of investment pretty defensive. So if you want to invest in property but you don't want all that hassle, then here are some of the examples of REITs that are listed on Bursa Malaysia, and as you can see here, they are also providing pretty good yields. In fact, it's more than 5%, which is very much higher than what FD is offering. And at the same time, you're also enjoying the potential whereby the property prices may appreciate. And when property prices appreciate, it will be reflected on the REIT prices on Bursa Malaysia. So you get capital gain at the same time you're enjoying a very high dividend yield. Now, the third area that might attract a lot of attention in 2023 is no other than tourism. Because China has reopened and all these tourists can't wait but to go out to travel again. On the 8th of January, China has fully reopened, but I think in terms of tourism, it will happen in the following stages. Number one, Chinese New Year is around the corner. So I think the first wave of tourism is not going out to other parts of the world, but within China itself. All these people who have been locked down in their home for the past 2 to 3 years, they are eager to go home to spend some time with their family. So therefore, the first wave of tourism will happen within China, whereby millions of people are rushing back to their hometown, and that will increase in demand in terms of local transportation, the air flights and things like that. Once Chinese New Year celebration is over, there comes the second wave whereby all the foreign investors are waiting for. They are eager to go out to see the world again. And in the Malaysia context, we are also preparing for that to happen. In Malaysia, we are going to ease the arrival process for Chinese tourists, and that will obviously translate to more Chinese tourists coming to visit our country. Just look at this table over here. In the past, before the COVID-19 pandemic, every year in, year out, we are talking about roughly 1.2 to 1.3 million tourists coming from China visiting Malaysia. Now, of course, don't talk about pandemic time because close to 0 people came to Malaysia, right? Just look at these 2 periods of time with 1.2 to 1.3 million people coming to Malaysia. We are able to rake in roughly 3 billion to 3.7 billion ringgit to our Malaysia GDP. So, with pent-up demand on tourism coming to Malaysia, chances are this 1.3 million is underestimated. It may go up to 1.5 or even 2 million tourists in 2023, and that will definitely translate to a higher number compared to 3.7 billion that was registered in 2019. So as investors, in order to position ourselves for this big catalyst, there's no other than a few sectors within the market. Number one, it could be airlines, but the thing about airlines is that as a tourist, you can choose 101 airlines to travel with. So it's very difficult to pinpoint which airlines is going to benefit the most. But all these tourists is going to one same place before they are allowed to enter Malaysia. And that place would be the airports. And that's why the airport could be the biggest beneficiary for this tourism team. So looking at the dividend track record of Malaysia Airport, you can see that every year they have been paying out at least 50% of their net profit as dividend. Of course, year in, year out, as they make more profit or less profit, that will fluctuate in terms of the dividend payout. But what I want to point out here, which is quite interesting, is in 2014, whereby they paid the least amount of dividend despite paying out 61% from their net profit. What happened over there? In 2014, Malaysia Airport decided to diversify their business overseas, and they acquired airports in Turkey. During that time, Turkish airports were actually loss-making, but Malaysia airports management think that it has very long-term potential. So therefore, they made that investment, and right now, today, actually, all their acquisition in Turkey is one of the top 10 busiest airports in Europe. The fourth area that could drive the stock market in 2023 would be the commodity stocks. That is in line with the inflation theme that is going to happen in 2023. By the way, I don't know how many of you know that I came from a corporate banking background and left my job to start this media business alongside Peter and CK. But I have to say that starting a business isn't easy, as you need to think about cash flow management, business model, tax planning, and the list goes on and on. Rumor has it that 2023 won't be an easy feat economically, hence, as a business owner ourselves, we are organizing a physical event together with Next Up Asia and its largest entrepreneurs and startup community in Malaysia and Alliance Bank to help you in whatever ways possible in securing growth for your business. Check out this link to find out more and secure your seat now. Back to our video. Now we are talking about the war in Russia. Now Russia has actually cut the gas supply between Russia and Europe. Therefore, Europe is experiencing a shortage in gas. We have a very high pent-up demand from Chinese tourism. When they travel, it's going to consume a lot of petrol, oil and gas and things like that. And to make things worse, OPEC has agreed to oil production cut. So on one hand, you have lesser supply. On the other hand, you have more demand. So that could potentially drive up crude oil prices in 2023. With that commodity backdrop, I want to share this story with you guys. I've put a mock-up of the company's logo over here, but because of regulation issues, I'm not going to reveal the name. So this company is one of the largest independent FPSO leasing companies globally. What is FPSO? FPSO stands for Floating Production, Storage and Offloading Facility. Now, still, it's very technical. What is it really about? So suppose you have an oil field whereby people expect that there's going to be 100 years worth of reserve for you to tap on. So because it's going to be a long-term investment, chances are the oil and gas company is going to set up a permanent rig in order to draw out the minerals from underground. But let's say, for example, this oil field can only last for the next 20 years or so. So it doesn't make a lot of sense to actually build a permanent rig over there. It's very expensive. Now, during this time, it is more economical to actually deploy an asset like a FPSO to the area so that once the production is completed, they can actually sail away to a different location. And this is what this company does, and it is one of the largest in the world. So because they're involved in oil production, the activities of extracting minerals underground, increasing oil price is generally good for them because potentially more oil major companies may want to produce more to exploit that high oil and gas prices, and therefore they will demand more of such assets to be deployed, and that is a good thing for a company like this. On the first glance, if I don't tell you what company is this, actually their financial record looks a bit questionable. Why? Because number one, it has a revenue of 1.7 billion, a profit after tax of 177 million ringgit, but look at their borrowings, a whooping 10 billion ringgit. 10 billion ringgit borrowings, but you're only generating 177 million ringgit a year. So how many years do you need to take to actually repay all the borrowings? And because of that, their net gearing is actually very high. You're talking about more than 1 times of net gearing, which means for every ringgit of equity that they have, it is borrowing 1.17 times more. Well, of course, that is just the surface of it. If you understand the business well, then you will know that actually this is okay. Because if you look at this ratio over here, which is their order book over their net debt, for every ringgit of debt that they have is actually being supported by 9 ringgit of order book, which means to say they have actually plenty of revenue to pay off this debt. Even in the worst case scenario, let's say they lose 50% of the contract, their order book to net debt ratio would still be around 4.5 times, for example, which is still very healthy, and they don't need to worry about their financial obligation in a very long time. So how long is long? Let's look at their order book, and this is the order book of the company, and as you can see, it has a very long-term contract of up to 2044. And if you want to be slightly more conservative, then you take a median whereby most of the contracts will be over, which is around this period of time, right? So you're talking about from 2023 all the way to 2035, they're actually quite safe because all the fleets that they have has already secured with a contract. So we don't need to worry too much whether they are able to service their borrowings or not. Apart from benefiting from potentially higher oil and gas prices, this stock also involved in a very important area, which is renewable energy. Right now, this company already has 175 megawatt of producing renewable energy income stream. And going forward, over the long term, you are talking about more than 5,000 megawatt in the pipeline. So going forward, this company is going to transform from a very traditional oil and gas company to a very interesting, sustainable, renewable energy company. So that is the long-term catalyst that you can ride on going forward. Last but not least, I think this sector is easily understandable by most of the viewers here because we are talking about automotive, cars. So before we talk about the catalyst in 2023 and going forward, I want to further break down on Malaysia's TIV. Now, it's very clear from this chart that 2/3 of the market actually prefer Perodua and Proton for obvious reasons. But what is more interesting is that if you look into Perodua sales, they're actually capturing higher and higher market share on the expense of Proton because Proton's market share has dropped from 25.2% to 21.4%. What is more interesting is this. We can see that Toyota has been losing market share, Nissan is also losing market share. Now, I can only take a guess here that people are actually switching their preference to Honda because their market share has increased during this period of time. And going back to our topic, why 2023 is going to be interesting for the automotive sector is because this is the thing. We are talking about replacement cycle of cars from internal combustion engine to electric vehicles. Malaysia is going to bring in a lot of very exciting new EV launches. Just imagine if every car in Malaysia is going to change from an internal combustion engine vehicle to an EV, how big the market is going to be. So that would be the catalyst for the long term in Malaysia on the automotive sector. So here are some of the examples of automotive stocks in Malaysia. In terms of dividend yield, it's also very interesting. Generally, you can fetch between 3% all the way up to 7.5% depending on which stocks that you are invested in. So just to give you an example of one of the companies that is involved in the automotive sector is this. Again, I'm not going to reveal the name of the company for regulation reasons, but this company generally involves in motor trading of these brands. And let me just give you a little bit of flavor of how many cars that they have been selling. So in FY 2021, their biggest sales actually comes from Perodua and they have sold close to 15,000 cars. Daihatsu, they had sold 1,300 cars. Volvo, which is a high-range car, they have sold 634. Hino, which is generally industrial vehicles, they sold about 139. And Volkswagen, they sold 540 cars in FY 2021. So when we talk about motor trading, apart from selling cars, it's also about servicing of cars. Now you may think that how many cars they sell will be correlated with the number of cars that they service. But let me give you the number of how many cars they have serviced in FY 2021. This company have serviced 136,000 Peroduas, 23,600 Volkswagen. So as you can see here, even though they sold very few Volkswagen cars in FY 2021, but they actually serviced quite many Volkswagens. Hino, even though they sold 139 only, but they actually serviced 11,300 cars. Volvo 11,100 and Daihatsu 8,800. So not necessarily they sold many of the cars means that they're going to service many of the cars as well. It depends on how many cars in the market that required these services. So then you may be asking, there are more and more all these 3S, 4S car companies mushrooming up in the market. So is it really a good business or not? The answer is yes. Why? Just look at this. In their vehicle sales and after sales, which is the service area, they are doing a gross margin of between 55% and 45%. So that's a very good margin for a business. That's why a lot of people want to set up their own 3S showrooms. Apart from selling cars, this company is also involved in manufacturing some of the car parts. The biggest car parts that they actually produce is car seat belt and also tire assembly as well for one of the major brands in Malaysia. Malaysia. This is a breakdown on their car parts manufacturing side. As I mentioned just now, most of the revenue actually come from tire assembly and also the seat belt. And hopefully with more EVs coming to the market and people are going into a replacement cycle of their ICE vehicle to EVs, that may actually bring in more sales for this company. So there you have it, the 5 possible sectors that is going to do well in 2023 for Malaysian market. Now, whatever that I've said just now is not an investment advice, but it will definitely give you a good insight about the market to let you hold a good conversation with your financial advisor. So hope you enjoyed the video. See you next time.